So give us some color, Tony, about what's happening today.
Hi, Sarah. Well, obviously, there's a lot of open-ended issues that the markets are having to deal with, and, of course, readjusting to the idea of higher inflation, higher interest rates, just huge uncertainty surrounding the outcomes of these things, not to mention geopolitical issues. And so there's lots of turbulence, and so what does a pilot do? And we all are pilots to our own portfolios. You seek out smoother air. And how do you do that? Of course, for an investor, and we would say this at PIMCO, we take a long-term orientation. And for the bond market, that means getting back to bonds, because this, to you bond investors, is what you've been waiting for. Let's remember there were 18 trillion of negative yielding bonds last summer, and today there's hardly any. This is exactly what you've been waiting for. The aggregation of all bonds in the U.S., including treasuries, corporates, mortgages, etc., the yield on that's probably around 360, 370 today with the move we've seen, with a little alpha, etc. Looking at a yield to maturity, potentially, at levels that are pretty good for a diversifier. And so that's the way to think about it. Think long-term as a diversifier with low volatility in the long run. These yields are quite attractive.
Explain what's happening when it comes to, Tony, the Fed rethink, because, you know, yesterday it made sense, right? He took the 75 basis points off the table. He sort of laid out his plan. The market seemed to like that. Bonds actually caught a bid. So why the sharp reversal today, in your view?
Well, is it really a rethink, or is it just simply ongoing uncertainty surrounding the numerous issues we're thinking about? I think the Fed's caught in what I'd call, and I'm thinking of the Seinfeld episodes I've been watching, the opposite episode, the George Costanza rate hike cycle. The Fed will be doing the opposite this year of what it did during the last big inflation battle of 1994, when the 10-year yield shot up to over 8%. Back then, Greenspan was known for so-called gradualism. Greenspan gradualism started off with small moves, 325 basis point moves, 250 basis point moves in May and August of that year. Then, wham, 75 basis point move. You'd think that would hurt the markets. Instead, it ignited a big rally, and markets never looked back, never started thinking about those higher yields until recently. So here you see the Fed acting aggressively. People yesterday said the Fed wasn't aggressive, but it has an aggressive plan, and it's told us it will move expeditiously, et cetera, and it's highly attentive to inflation. So investors should trust in the Fed. What you should be doing is listening to the adage, don't fight the Fed. And today that means trusting in the institution to battle the inflation level down, which will ultimately be good for investors.
Down 1,300 points now on the Dow. It's just getting worse, Tony, down 6% on the NASDAQ. What do these rising rates do to the economy? If we continue to see yields go up, we continue to see the Fed have to move. I mean, we've already seen mortgage rates spike. What is PIMCO's view on how much economic damage will be done as a result of what's happening with rates?
Well, we're sanguine about the outlook for the next year, and we put odds similar to what the New York Fed has on its website regarding the yield curve, odds of lower than 10% for recession in the next year. Looking 18 to 24 months out, that figure rises, call it 30% or so, because we are, in fact, in the midst of a fast-moving cycle with the jobless rate falling and likely continue to fall. But the good news in terms of the slowing of the economy, if it occurs, it'll correct the imbalances that are causing problems. Chair Powell mentioned yesterday the numbers of job openings, around 11.5 million. The numbers of unemployed is half that. And so if there's a reduction in demand that reduces labor demand, that can be a good thing. Final note, real quick, the burden is, there's more burden sharing in the markets. It was all about the bond market weakening from 2 to 3% in the 10-year. Now it's spreading around to other areas, which means the Fed's handiwork can work, and it can be successful in getting to that so-called an elusive soft landing.